All right, I'm going to go ahead and do a brief presentation today. This presentation is going to be designed to explain using covered calls to supplement dividend income. This video is going to be more geared towards my income investors, my investors that don't want to take on too much risk, but they want to use their investments to generate income, generate cash flow. If your investment objectives are more geared towards speculation or growth, this may not be the video for you. You may want to take a look at some of my other stuff. Without further ado, let's get into some of the concepts and kind of break down how this works for you. First concept that you want to understand is what is a call option. Now, you may want to do some prerequisite work before you dive into this video. I'm not going to go super in depth on all of the terminology that you may need, but we'll kind of briefly touch down. A call option gives the buyer of the option the right to buy the underlying stock at the strike price until expiration. A call option gives the seller of the option the obligation to sell the underlying stock at the strike price through expiration. Premium is the amount paid or amount received when buying or selling. Each call option represents 100 shares of the underlying stock. What is a covered call? A covered call is a very basic option strategy, relatively low risk. It involves buying 100 shares of a stock and selling an option contract covered by those shares. Since you are taking a position as a seller, if the buyer exercises their right to buy 100 shares at the strike price and you subsequently get assigned, meaning that you have the obligation to sell your shares at the strike price, your existing 100 shares will simply be sold at the strike price. You don't have to go out into the market and obtain those shares, so it alleviates a lot of the risk. Your downside risk is very similar to stock ownership. If it moves down, of course, that's going to be unrealized gain. That's going to hurt you. However, you do have to worry about opportunity costs on the upside, since you have the obligation to sell at the strike price. But some of that premium that you receive to sell the stock, that's going to offset some of your downside. So you do want to take that into consideration. So let's say that you already own ABC stock. You own 100 shares of ABC stock. And you decide that you want to sell ABC option at a strike price of $15, expiring April 17, 2015, while the stock is currently trading at $10. So you're going to bring in some premium for that. And I'm just giving very generic examples. ABC isn't a real stock that I know of. Now, let's say that the stock shoots up to $20. So it shoots up from $10 to $20. Essentially, you're going to share in those gains only up until $15 because you have that $15 option. And you have the obligation to sell at 15. Once it shoots up to 20, the buyer of that option is likely going to go in and say, hey, I want to exercise my options to buy at $15. And you're going to have to sell at 15. Subsequently, you're going to miss out on about $5 per share in gain due to selling the call option against your shares. However, when you're selling your options, you want to what I prefer to do is sell my options out of the money, and I try to sell them at a point where I don't think I'm going to get assigned, because a lot of times I don't want to get assigned. I want to make sure that I hold on to my stock and continue getting my dividends along with that premium that I'm receiving for the option. And most investors sell covered calls at a strike price that is higher than where the stock is currently trading, and that's considered selling your options out of the money. Now, you can also sell your covered calls at the money or even in the money. That gets a little more complex. There's other things you want to look at when doing that, but those are concepts that I may cover in later videos. How can covered calls supplement income? Let's take a look at stock symbol SO, Southern Company. This is a company with a solid business model, consistent earnings, and a strong revenue stream. A lot of these utility companies, they hold up in recessions, and I mean, that's one thing that people are going to pay. They're going to pay their utility bills. I don't know about you, but I'm going to make sure that I have my electric, gas, etc. Currently, they pay a quarterly dividend of 52.5 cents with a respectable yield of about 4.68%. So for every share of Southern Company that you own, you're going to receive a dividend of 52.5 cents. That's very respectable. The shares are currently trading at $44.87 per share. So let's say 200 shares will cost you about $8,974. Now I'm doing everything without factoring in commissions and fees, so bear with me. It may play out a little bit differently in real world brokerage terminology, or in real world brokerage terms, I should say. Now, given the current dividend, you would collect $105 per quarter in dividend income on this particular stock. Now, on that amount of money, $105 is nothing to complain about. I mean, that's $105 in passive income. I don't know about you, but I wouldn't complain about that. Now, currently, the April 17, 2015 $46 call is bidding 53 cents. Now, in the world of options, as I mentioned, each option contract represents 100 underlying shares, so that's going to equate to $53 per contract. This contract has approximately 45 days until expiration. So selling this option would yield you $106 for 2 contracts on 200 shares. If a quarter equals approximately 90 days, the option would yield you approximately $106 per quarter per contract. Now, if you get assigned, you will still gain $1.13 per share and retain the premium received on the option. That's one of the risks of assignment. If you get assigned just before the X date, you may not get the dividend. So again, I reiterate, you may want to sell your call options at a point where you don't think they're going to get assigned. You also want to be aware that all things being equal, an option premium will tend to decline with time. This increases the likelihood that you can buy it back at a lower price. So let's say that you sell the option, the stock stays flat, and it's 3 weeks later, and you decide, hey, you know what? I want to go ahead and cover this option. There's a good chance that you're going to be able to cover that option at a lower price than what you sold it for, because options tend to decline in value along with time. There are some exceptions to that, but generally speaking, options, all things being equal, as time decays, they tend to decline in value. So let's take a look at the hard numbers. Per quarter, the stock will give you 52.5 cents per share. And selling options will bring you approximately $1.06 per share on 100 shares, given there are no assignments. This totals about $1.585 or $1.58.5 per share on a quarterly basis, and approximately $6.34 per year, subsequently bumping your yield up to about 13-14%. That's nothing to complain about. I mean, the market on a whole only goes up, let's say, maybe 10% historically. Now, granted, you still face the same downside risk of outright stock ownership and the potential for missed opportunity on the upside, but it's still hard to overlook a potential yield of 13-14%, especially if you're an income-oriented investor. If you have more growth aspirations, you may not want to give up that opportunity for growth, especially in a bull market like we're in today. But for an income investor who's just looking slow and steady, wants just a cash flow, pay bills, what have you, this is an ideal tool. All right. What I'm also going to do, I'm going to go ahead and pull up my E-Trade account, and we're going to go ahead and take a look at some of these things I went over in the presentation. So let's go ahead and pull up a quote on Southern Company. That's symbol SO. As you can see, we'll go ahead and pull up a 10-year chart on Southern Company. Little bit of volatility, but it's been a pretty consistent performer. Let's go ahead and look at the earnings. And the brokerage firm that I utilize is E-Trade. I'm sure some of you may use different brokerage firms, but I like E-Trade. They're a pretty good firm in my opinion. Look at the earnings, somewhat cyclical, but the earnings have been consistent. Looks like they're projected to stay on par to where they've been. So a lot of these utility companies, the business model is relatively safe. As you all know, you're not going to have too much to worry about. Not like a pharmaceutical company or something that that has a lot of risk, or maybe relying on some sort of FDA approval, etc. As you can see, dividend yield 4.65%, quarterly dividend 52.5 cents. And let's go ahead and take a look at some options. I'm sure a lot of you are familiar with looking at options, but we'll go ahead and take a quick look. We're going to look at calls only. Let's take it out to April 17th. And as we can see, it's trading at 45.15, a little bit higher, I think, than when I did that video. And let's look at the $46 call. Right now, it's bidding 60 cents, meaning you could sell this particular option and bring in 60 cents. So that's how you would do that there. Now let's go ahead and take a look at setting up your order. That's the last thing we're going to cover real quick. And if you have any additional questions, again, don't hesitate to reach out to me. I love this stuff, so I'd actually enjoy helping anybody out who has any questions. All right, so let's go ahead and we'll mouse over trade. We'll mouse over trade here, and then we're going to go over to buy rights. They're called buy rights because you're buying the underlying stock and then you're simultaneously selling the option. So the first component to your buy right is going to be your buy order. Going to go in and we'll say we'll buy 200 shares of, we'll use Southern Company. There's a lot of other ones out there. Again, AT&T is a good utility company that pays a solid dividend, safe company. Again, it's up to you guys. I'm putting this out there more for informational purposes, so you can do what you want with it and do your own research. Then you come into the option and you're going to go sell open. The reason you're doing sell open is because you're selling, meaning that you're selling the option and you're opening up a position through selling. So it's a sell open. We're going to do 2 contracts. Like we mentioned, each contract represents 100 underlying shares, and we're only buying 200 shares. Type is going to be call. We're going to look at the April 17, 2015, and we're going to go up to 46. So basically, we're banking that it's going to stay below 46 by through April 17, 2015. Price type, you can go ahead and what a lot of people like to do is net debit, meaning that your order is only going to execute if you can pay out the amount of your debit or less. So in order to really try to get a feel of what your net debit is, you're going to look at the ask price on what you're buying. You're always looking at the ask when you're buying, so that's 45.87. And then you're going to go ahead and you're going to subtract the bid on what you're selling. So you subtract 0.6. It's going to give you 45.27. They put that down here to kind of give you a feel. And I'll go in and I'll use the net debit amount, 45.27. So I'm only going to get into that position if I'm able to get that debit or less. And you can do the order good for the day. You can also do it good for 60 days, meaning the order will stay out there for 60 days if you don't get filled. We'll just do good for the day. And then we'll come down here and we will preview order. I'm not actually going to place this order, but that's essentially how it would be done. And that pretty much concludes the video. If you guys have any questions, again, don't hesitate to reach out, and be happy to help you guys out.